So, as I was saying, there are ways to read and analyze the balance sheet using financial ratios. Different ratios can tell you different things and provide answers to different questions, kind of like my psychic Paquita does for me, depending on the day. Except ratios tend to be more accurate than Paquita. Anyway, current balance sheets usually also have data from previous periods, so you can compare how financial performance has changed. So basically, these are the benefits of looking at ratios. The first ratio we're going to look at tests short term financial risk. It's called a current ratio, and it shows a company's ability to generate enough cash to pay off all its debts once they become due. This is something a bank will look at for a loan, specifically for things like a vehicle loan. To calculate it, divide current assets by current liabilities. So, if Lou's current assets was $680 and his current liabilities were $425, his current ratio would be 1.6. That's it. But what does this number mean? If the current ratio is greater than 1, it shows that current assets are larger than current liabilities and indicates that the business should be able to convert its short-term assets, cash, inventory, and accounts receivable, into cash and pay its short-term liabilities, accounts payable. On the other hand, if the ratio is less than 1, the current assets are less than the current liabilities, and the business may be in danger of not being able to satisfy its short-term liabilities as they are due. So, Lou's ratio of 1.6 is considered fairly healthy. But the real test of the current ratio is not today's ratio, but the longer-term trend. You will want to see a consistency over 5 years or more in which the ending current ratio is above 1.0. If it's less than 1 to 1, a business doesn't have enough current assets on hand to cover its short-term debts, and it's in a tight position. The higher the ratio, the better a business can cover its liabilities.